Good afternoon. My name is Joe Christie, and welcome to the Capital Property Fund's July webinar update. And joining me is Xander Ryan.
Thanks, Joe. Just with a bit of housekeeping to start off with, no one's got their video cameras on, just for a bit of comfort for everyone. And the chat function has been disabled. We will have a Q&A at the end. So if you do have any questions, the Q&A function will open and you'll be able to ask them then. We're going to talk for about 45 minutes, maybe a bit less, and then we'll have a Q&A at the end. So I'll share my screen now. And we'll get going. So just to start off with a quick disclaimer. So Joe and I, we can't give financial advice, and the returns that we talk about today aren't guaranteed, and they're subject to the performance of the underlying asset. So what are we going to cover? We're going to do a brief overview of what's happened with interest rates the last couple of years and how we think that's going to be impacting property-based income. Next, we're going to go a bit into why Southeast Queensland continues to outperform and why we like the area. The third point we're going to talk about is our credit enhancement strategies and how it safeguards investor capital. And finally, a spotlight on a new loan called the Junction, which will be coming at the end of August. So to start off with, the Australian official cash rate. So Joe and I, we've talked about it previously, but we often talk about the hump or the mountain that's being climbed. And you can see that in the graph where interest rates were 0.1% for such a long, for about 2 years there. And then I think we got 13 interest rate hikes to 4.35. And then this year in February, we had the first rate cut, which kind of indicates to us that we're kind of on the other side of that big hill and we're on the way down. So we think that's a positive for us. And we've got two kind of house price graphs to show you.
Yeah, just look, sorry, just to chip in there before you go to the next slide, is that, we use, to hang off Xander's analogy of the hump or climbing the mountain. We think that the worst is behind us and that we're now set for the next turn in the cycle.
And even though we did think we were going to get an interest rate cut this month, which was a bit unexpected that there wasn't, we do think there'll be another 1 or 2 this year. So just to cement that we are on the way down for the foreseeable future.
And if you look at that the analogy of climbing the mountain is that while interest rates were going up, you had supply chain disruptions, you had materials inflation, you also had labour inflation. And then on top of that, you had builders that had signed up to fixed price contracts going bankrupt. So really, we're trudging up the hill. And now we're, as I said, we're over the hump and on the downhill walk now. And as I said before, we believe that the worst is behind us.
So just a quick kind of spotlight on the last 365 days of house price data for some of the major cities. As you can see there, some cities were performing well, some weren't performing well. But I've drawn a blue line, and that's when the first rate cut was in February. And as you can see, since then, even though it was just one cut, 25 basis points, it's had a real impact on the housing market. And in the next slide, you can see this is the house price data since the first rate cut. So about 2 to 3% up for the major cities. And we think that's really supportive of valuations and feasibilities going forward. Feasibilities, if the valuation's higher, there's a higher expected profit at the end. So we think moving forward, that first rate cut, even though it seems insignificant, you can see from this data that it did have a large effect.
Absolutely. And it is a double-edged sword because the completed stock typically that we're funding is having a higher sales price. And also what that does, it also improves the feasibility of the borrower or the people that we're lending to as well. So it's a double-edged sword in the right, a positive for both, for 2 reasons.
And then the final thing we'll talk about is just inflation. Joe talked about it already, and you can really see it in this graph that we had that really high inflation, nearly peaking at 8% year on year. And we've come down to that kind of normalized level where it was that pre-COVID level. You can see just below 2%. It's in that CBA, the RBA band of 2 to 3%. So we think that there was a period where builders were going broke through this period. They were locked on those fixed price contracts. And now that we're not saying that building costs are going to fall. It's just that the rate of change is stabilized, and that's a positive. The rate of change stabilized, so now we can foresee, or there's more predictability about what will happen going further.
Yeah, and look, it ties into confidence as well. Is that if you're lending money, you sort of got a little bit more confidence that the feasibility that you're looking at for the underlying borrower, you can have some confidence that that it can be built for the estimated price, etc. So it bodes well for lending into that market.
And then just a bit of a market commentary. We meet once a week for our lending committee, and just the throughput. We get quite a few opportunities come to us, and we're seeing more and more of that built form construction or townhouse development. So I guess the business was probably focused more on land subdivision, which is less intricate. You saw that spike in inflation. There's not as many moving parts. So you don't have to be concerned about getting stock of steel, timber, and getting those specialized trades. Whereas now that we've come down that hill or the mountain, and we're on the other side, we think that it's a good time to be in residential or building townhouses. So you'll see, and we'll talk about the Junction later. That's a townhouse development. We've got some other townhouses or apartment kind of low-rise apartments in the pipeline. And I guess just touching on the rates of these opportunities, even though we've started to see interest rates fall, and we think they will probably continue falling for maybe 1 or 2 more cuts this year, we've seen nothing below a 10% through the lending committee. They're probably closer to that 10.5%. And quite a few of these opportunities have second mortgages as well, with that 16 to 18% range. So our market commentary is that things are strong, and that pipeline of a developer might have had a block of land that they were waiting to do a development, and they've just seen interest rates skyrocket. They've seen inflation skyrocket, and they might have halted the project. Now that they can see they might be on the other side of that hill, it's a good time to start, and that's why we think the next 1 or 2 months is very exciting for us.
Yeah. And to summarise what you've said, you're exactly correct. Is that this time last year, we probably weren't doing a lot of what we call built form construction. We were doing built form construction, but it was mainly industrial and commercial. And we're doing the residential stuff we're doing was primarily non-built forms construction, which was land. Now that we're on the other side of the cycle, what you're seeing is a lot of, we will continue to do industrial and commercial built form construction, but the feasibility or the commercial viability of built form residential looks a lot better. And the analogy that I use is, and the reason that why we like it better is that all those things Xander was talking about, materials inflation, labour inflation, supply chain disruptions, all seem to have normalised. You don't have as many builders going bankrupt anymore because of all those things we just spoke about. And secondly, nobody's signing a fixed price contract without some clause that allows for cost variations. So a lot of those things that were troubling us 12 to 18 months ago are no longer troubling us. There's still an undersupply of residential housing stock in Australia. So we are moving into more built form residential construction to complement our portfolio. And what we're seeing too is that we use the analogy of sometimes people are just outside the flags, because they've had a builder go bankrupt or they've had some delays due to supply chain disruptions. When they're now on the other side of the cycle and they need a little bit of assistance getting back between the flags. And I think probably for that reason, we're seeing interest rates or the rates that we're able to pass to our investors staying around that 10 to 10.5%, maybe even 11%. And I think everything that we're seeing through the lending committee, as you said, nothing below 10%. And that's looking at probably to September, October. I don't think we're seeing anything below 10. So certainly for the next quarter and beyond, for first mortgage security, everything around about that 10% mark.
And I guess just a final comment is that these are just observations that Joe, myself, and the CPF team are seeing. You can see it in the data of inflation in the cash rate, but we're no economists. We don't have a crystal ball what's going to happen in the foreseeable future, really. And it's just, I guess, another reason we like 12-month terms is that we can kind of see 12 months in ahead almost. So we just like those 12 months, and again, we're just kind of commenting on what we're seeing. But yeah. So, Joe, can you walk us through why Southeast Queensland and what are some of the things that we like there?
Yeah, thank you, Xander. Look, some of our investors who have been with us for a while will know that we have a fairly strong bias towards Southeast Queensland. A large portion of our portfolio is focused there. And look, we like Southeast Queensland because, look, it's a market that we know very well, and we've had a lot of dealings in that market. But some of the fundamentals of that market, in addition to that, are migration, both interstate migration, so from the domestic population, and overseas migration. So if we look at retirees, it's a worldwide phenomena where retirees around the world tend to head towards warmer climates. So if you look in America, they tend to head south towards Miami. And if you look in Australia, you have retirees from, say, Melbourne and Sydney that retire, sell their home, and then they move into typically into Southeast Queensland. And when they're coming into Southeast Queensland, they would sell a home in Sydney or Melbourne for $3 or $4 or $5 million, and then they're able to relocate into Southeast Queensland, buy a nice home, then have excess cash available. So they're retirees that are driving population growth. They're coming into the Southeast Queensland market with available funds, and they're spending that money because they're in the retirement phase. So that's good for the Southeast Queensland economy. Then at the other end of the spectrum, you've got people that are moving into Southeast Queensland that have been driven from an affordability perspective. So you've got young, educated and highly skilled people that can't afford to buy a home within the Sydney or Brisbane market. However, they can move up to, say, Brisbane. They can obtain employment on the same or similar wage as what they were earning in Sydney or Melbourne, but they're able to afford a home in that market. And I want to talk more about that because you're actually going to see a highly skilled employment base coming into that Southeast Queensland market, which will feed upon itself because it also drives other commercial dynamics such as startup businesses looking to get access to a highly skilled labour market. You've also then got overseas migration. We've all been reading the paper that you've got Australia has a large immigration intake, which is driving population growth. So population growth drives GDP, it drives white collar employment growth, which in turn and blue collar employment growth, and then which in turn drives the need for domestic or residential accommodation and workplace accommodation. So so migration is a big thing for Southeast Queensland. So overlaying that population growth due to interstate and overseas migration, you've had a lack of new supply. And that's been an Australia-wide phenomena where because of supply chain disruptions, construction costs, both labour costs and material costs, it's been difficult to bring new residential supply, but also office supply as well. So there'll be a lot of white-collar employment growth coming into the Southeast Queensland market. There's a lack of new office supply for that market, which in turn will drive values and rental growth. So we think lack of new supply bodes well if you're funding people that are providing a supply into that marketplace. The other thing we like about the Southeast Queensland is also the economy. It's a diversified economy, so it's got tourism, healthcare, IT, tech services, government, agriculture, mining, etc. So it's a really good diversified economy. So it's not like it was 20 or 30 years ago where it was subject a very narrow economy. So it's got good shock absorbers within that economy. And as I mentioned before, you've got a really good, highly skilled labour market, which is coming into that Southeast Queensland economy. So you're seeing a lot of innovative startup companies such as pharmaceutical companies, IT companies, technology companies, etc., that have access. They're coming up, headquartering up in particular the Brisbane market, and they've got access to a highly skilled and available labour market. The other thing too is you've got an unprecedented infrastructure spend at the moment. Putting aside the Olympics, you've got the Cross River Rail project, which is several billions of dollars. You've got Brisbane Live precinct, which is several billions of dollars. You also had Queen's Wharf project, which is now completed, but an unprecedented infrastructure spend. And then on top of that, we've got the Olympics coming in around about 7 years' time. So there's going to be more money being spent. That means that there's going to be demand for consultants, engineers, architects, other white-collar workers, highly skilled tradespeople, blue-collar workers. All those people are going to be sucked into that economy. They'll all need to be housed and accommodated. So, again, it just bodes very, very well for that southeast Queensland market. And look, the good thing that we have is we've got a long-term established relationships with some of the best, if not the best, private developers in southeast Queensland. So we're very keen on that marketplace.
Just to like we've talked about migration, lack of new supply. They're excellent tailwinds for this market. Are there any headwinds you see coming, or anything that you're looking out for that we think, or this might be a problem, or just something to look out for?
Now, that's a very good question. There will be headwinds. For example, I think it's going to be difficult if you're coming into this market securing access to highly skilled labour. For example, if you're doing a residential development or even an industrial development or a commercial for that matter, you would need to be lending to people that have long-term relationships with their builders and their civil contractors and their engineers, because I think it'll be very hard coming into this market in the next couple of years if you don't have those existing relationships, having access to that market. And we have seen that where you've had builders that have come in from, say, Victoria coming into the Brisbane market. They don't have a relationship with the underlying subcontracting market. And as a consequence, some of those have failed. So our preference would be to be looking to lend into borrowers that have long-term relationships with builders, contractors, architects, engineers, etc. in that southeast Queensland market.
And just to add on to that, long-term relationships, a loan like Tingalpa, which is finishing a Mark Drillich one, he'll be moving on to the next one, Oxley, which will be coming in the next coming months. And it's just getting those high quality borrowers. As you said, the most risk is when you lend to someone for the first time. If we can keep those high quality repeat borrowers, keep doing their projects, keep funding them, that's less risky, and it'll probably increase our exposure to southeast Queensland, because we've lent to lots of the borrowers there before, and they'll continue doing development. So.
And if we look on that, if we talk about Mark Drillich, who was doing an industrial development in Tingalpa in Brisbane, for those of you that aren't familiar with it, but because of what we just spoke about, what he is doing and what a lot of our developers are doing, bringing in resources in-house so they can lock in access to engineers, construction expertise, etc.
So moving on to our credit enhancement strategies. So we've got 7 on the screen just there, and we've kind of ordered them in the order that kind of they credit enhance. So to start off with, before a loan settled or something's come through the lending committee, do you want to just talk about the independent trustee we have?
Yes, thank you, Xander. So some of our investors may not be aware of the fact that we have an independent trustee across our credit funds. And the independent trustee appoints capital property funds under investment management agreement. And the role of the independent trustee is to ensure that we comply with the mandate of the fund. So we issue what's called an offer document or information memorandum, and that is signed off by the trustee, and it states the parameters of what the fund can invest in, what parameters such as what the LVR might be, how long the term could be, all those sort of things. And the independent trustee makes sure that we comply with the mandate of that fund, which I think provides a higher fiduciary overlay for our investors. And the other thing too, which I think is important, that every asset of the fund is controlled by the trustee. For example, all the mortgage documents are signed by the trustee and held by the trustee. And similarly, all cash. No money is paid to capital property funds. It's all in a trust account. So it's AML is our trustee. So it's an AML trustee cash account, and so they control all the cash assets. And if we need to make a payment to a builder or a payment to a borrower, we need to properly instruct the trustee to do that. So it's just an important thing, a part of our credit enhancement strategies.
Yeah. And then, so we've got the independent trustee, and then, as I said, the lending committee meets once a week, and we get quite a few submissions, and every submission must have an independent QS, so an independent quantity surveyor report, which will outline the costs of the project. So if they're building 10 townhouses, it might say it costs $1 million. And then they'll have an independent valuation as well, which says these 10 townhouses are worth $10 million or whatever it is, because they're the two pillars that we need to know what it costs, and we need to know what the valuation is, so then we can build everything else around it. It's a very important step, and I guess one of the words there is independent. It's not my brother doing the valuation. It's an independent that if it's a childcare centre, the valuer will only do childcare centres, or they're a specialist in that sub asset. So we know exactly what the valuation is, and what we're lending to.
Yeah, no, it's very true, because we get a valuation. Generally, if there's a parcel of land, the valuation report will say this is the valuation as is. So this is the valuation of the parcel of land as it is, and then it'll also give a valuation of as if complete, and it'll say the parcel of land as is worth $100, and the parcel of land once you've built the townhouses, whatever you've done, will be worth $200. And then tied into that is the quantity surveyors report. And for example, why that is so important is we say, well, the finished product's going to be worth $200, but if it's going to cost us $250 to build the completed project, then you know that it's not a financially viable project. The other thing too, which I want to just touch on, so an independent quantity surveyors report and an independent valuation report from an appropriate valuer is really, really important. Typically, we don't take on any planning risk. So every loan that comes to us will have a planning approval. Sometimes you'll have a parcel of land that has what's called an as-is right, or doesn't necessarily need an approval. Where that happens, often we will get a town planning report to provide commentary around how long it's going to take and the likelihood of getting the approval.
So it's come through the lending committee. We've got a valuation, we've got a QS report, and then it's time to determine if there's going to be any special loan conditions. So for a land subdivision like Spring Creek, where it's a Terry McKinnon, it's a land subdivision, so there's not too many moving parts. We're very confident in the borrower. The special loan conditions might not be as strenuous on Terry, whereas if it's a first-time borrower, or if it's a built form construction, so we're building townhouses or an industrial site or a childcare centre, then there's a bit more construction risk there. So we want to put in place some parameters to reduce that risk. So we've got the CPF client-side development team that we might appoint to a certain project. And what that includes would be them attending monthly site visits, and also working with the developer and the builder to ensure that the project's on track.
No, that's exactly right. I mean, we break the risks down into three components, being planning risk, construction risk, and marketing risk. And probably where most of the fear in the marketplace at the moment has been around construction risk. So we've got our client-side development management team, and particularly new borrowers that are doing built form construction, we would have a condition that they must attend all the monthly site meetings, as you said, manage the drawdowns. And look, the feedback we've had from our borrowers is that they don't see it as an arduous task or someone looking over their shoulder. It's really another shoulder to the wheel to help them navigate any difficulty. So it gives us a lot of comfort, and the borrowers like it as well. So that's probably a really good credit enhancement strategy.
And another special loan condition, if it's a residual stock deals, maybe like Sanford Rise or Yalambee, we might have sales targets that they have to meet. So they might have to sell 6 blocks by the end of the year, or something like that, just to ensure that the project's moving, that we have some in credit enhancement that will get repaid on time, or something like that.
Absolutely.
So, Joe, do you want to talk us through what a tripartite deed is and what that credit enhancement is for?
Yeah, so tripartite deed, what the name it sort of implies, tri being three. So there are three parties to the deed. So with every single construction contract that we have, we will be a party to that contract via a tripartite deed. So you've got the builder, the borrower, and then ourselves as the lender. And what that does, it does two things, is that it gives us the ability, we are a party to that contract. So if one of the parties fails, we can step in and complete the project. So for example, if the borrower goes bankrupt or something happens to them, instead of having the builder decamp and having time delays and cost delays trying to find a new builder to come in and complete the project, because we are a party to that contract, we can step in and complete the contract with the builder. So it reduces, as I said, time delays and costs, etc. The other benefit of a tripartite deed is because if there's a variation or a cost escalation, any changes to the agreed construction program, we have to sign off on those. So we're a party to that. So it's a standard risk or credit enhancement strategy across all of our construction loans.
Perfect. So then moving on to the next three are kind of intertwined in each other, but I'll start with funds released on a cost to complete basis. So if there's a project, we've got the QS report, independent QS report, and it says it's going to cost $10 million. We don't write a $10 million check and go, here's the money, see you in 12 months time, hope all goes well. We might give the borrower $3 million if that's what the land value is, that's what the settlement is for the land. And then they might, if we're building townhouses, they might lay all the concrete slabs. That might be $1 million worth of work. So once that's signed off by the quantity surveyor, that it's to Australian standard, that $1 million work has been done, then we will pay the concreter directly. So I think that's just, of all these factors for construction risk, I think that's one of the most important, that the money is being paid exactly to the person where it needs to go, that progress on site will continue. The concreter might have to come back next month or do something else there, and you don't want him to go, oh, I didn't get paid the first time, I'm not coming back. So I think it's a very important part that it's on that cost to complete.
I mean, just to interrupt you too, because look, the reason we talk about that, some of our investors may not be aware of that we're only releasing the money to once the work has been done and it's been independently verified that the quantum has been done, it's been done to standard, and we pay the subcontractor directly. And we have had cases where funds have been released to the site, but the program manager has been paying or releasing the funds to workers on other jobs. And so there is a risk if you don't monitor the release of money on a stringent basis that you're lending money but there's no work being done. So it's a good credit enhancement strategy.
And that the last point about monitoring the progress kind of ties into those special loan conditions. So a special loan condition might be the development team attend monthly site meetings, so they're on site, they're seeing what work's being done, they're meeting with the builder. Another point of the QS is they're seeing how much work's left done. So if they've done $4 million of work, they know that another $6 million to go, and is there a budget for $6 million? So that's also another point of meeting on site of the QS and just general making sure that the work's being done and we're paying for what's been done.
Yeah, that's very true. So the QS provides three things. Yes, the work's been done. It's been done to standard, and then that there is still, what the cost to complete will be. So there's still enough funds available. For example, you may be digging a car park and you've hit rock, and you didn't budget for that, and so there's not enough. There won't be enough cost to complete. So it's good to know that sort of stuff early, and you need to be able to adjust and accommodate for those things rather than being at the last minute.
Yeah. So if we're going to move on to our special highlight of the Junction, but if anyone's got any questions about any of our credit enhancement, or we'll have the Q&A at the end, and also feel free to call us or send us an email if you want any more information on these. So moving on to the Junction, it's stage 3 of a development, and I'll just quickly go through the characteristics of it. So the property security is 24.1 million. We've got a first mortgage and an LVR of 65%. Investor returns of 10.5%, so quite healthy there. An expected term of 12 months, and the purpose is 42 townhouses. So do you add a bit to that, Joe?
Yeah, look, thank you, Xander. What we like about this particular project, it's a large parcel of land, and as you can see on the slide, it's stage 3. So all of the infrastructure to the parcel of land has been completed. So the civil contracting work, curbs and guttering, power, water, sewer, etc. So all the hard work has been done, and then they've sold out stage 1, which was a combination of 2 and 3 bedroom townhouses have been sold down, and then stage 2 is in the process of titles have just issued and they're in the sell down now. So it gives you really good confidence around the saleability of the finished product. And the Junction is located at Ipswich, in close proximity to amenity. And by that, I mean you're very close to road and rail. You're very close to retail amenities. So it's very close to quite a large shopping centre within, it'd be a 2-minute walk. I was on site there the other day. You're not too far from the Ipswich CBD. It's just across the river. So we like whether your access to a close proximity to a tenant or to amenity. You haven't had to. It's not a location in the middle of nowhere where you've got to build a shopping centre. You've got to build a school. You've got to build all this infrastructure. All the infrastructure is right on your doorstep. The other thing too about Ipswich is that the residential vacancy rate is less than 1%. So if you can build housing accommodation, there's a very, very high demand for it. Also, you've got a very large RAF airbase located in close proximity to Ipswich. And so you're getting really good quality potential covenants from government leases looking to secure accommodation for military personnel. Typically, military personnel stay in one location for, short to medium term, and then they need to be relocated. So they're not looking to purchase houses. They need somewhere to rent for a short period of time. So the dynamics of that market are very, very strong. So just to talk about, this particular loan, one of the loan conditions will be our client-side development management team, led by Rod Moynihan, will be attending all the monthly site meetings, managing all the drawdowns or providing assistance. 12-month term. They're building a product that people want to build. We've met the builder. The builder is highly capable and competent. Just on that too, they did hit a big pothole where the prior builder went bankrupt. So there has been some transaction or costs incurred, but that was with a previous cycle. We're coming in fresh with a new builder on site who completed stage 2, highly credible. So I really like it, and that'll be coming in late August. And it's a good project.
I think as some of the people who attend our seminars, we break it into construction risk, planning, construction, and marketing. And with stage 3. Stage 1's been built and sold. Stage 2's been built and currently selling down. So that valuation's a real valuation. It's demand that's currently there. They're selling them as we speak, getting ready for the starting of stage 3. So we've got real good comfort about that marketability. And just on that marketability, do you know, this marketing or selling strategy is a bit different to what we've done previously. Just touch on kind of what the developer has seen in the market and why he's doing this.
Yeah, thank you, Xander. You are right. And of the 3 risks, I think personally at the moment, construction risk is still the big one. With the residential housing stock, you're building something that people want. So I'm quite confident around the marketing risk or selling down the completed product, particularly that we've got all those comparable sales. But this particular developer, which is different to some of the others we've used, he is selling into the investor market. So where we're finding the sales are happening is self-managed super funds or other investors that are buying the completed stock and then renting out the completed stock for quite a good yield. He'll continue to do that, and it's been very, very successful for him. I will say too that, which I forgot to add, this is a gated community, and it's quite a nice community, really good common areas, and it's hard to say it's high end being in Ipswich, but it's a good quality estate, and the build quality is very good, and I think it'll go very, very well.
Yeah, and just to reiterate, this is expected mid to late August.
That is correct.
So we'll be sending out some more information about this one, and we're very excited for it. So we've kind of touched on all the things we want to talk about today. We talked about that interest rate cycle, where we think we're at the moment, some of our credit enhancement strategies, and then just a spotlight on the Junction. So we're just going to open the floor to the Q&A. If anyone does have any Q&A questions, feel free to enter them in the chat. I guess in the meantime, if anyone does have those questions, put them in. But I guess we can just talk about what we see coming in. August is going to be a busy month for us. Joe, myself and Noah will be up on Brisbane on Monday and Tuesday and Wednesday next week. I think we're seeing 5 sites, meeting some brokers as well. So we do have quite a full pipeline of opportunities coming. And I guess in the monthly portfolio update, we'll speak about that more. But the month of August, we will have quite a few raises going on, so something to look out for.
That's a very good point. Is that some of them, like we did one, I forget, we're doing so many now, but one of them they're filling very, very quickly. Some of them we're not even releasing to the market. Which one was that one?
Brookwater.
We just did a childcare centre in Brookwater in Ipswich, paying 10.5%. And for the first mortgage and 18 for the second. That was filled before we even got it out to marketplace. So look, a lot of the stuff is just filling so quickly. There's a lot of demand for the product. But if you have if you're interested to place available funds with us, reach out to the team. If you haven't set up an account with us, reach out to the team and we can help you get an account established. But we do have a lot coming through. As I said, nothing below 10 for a first mortgage. Second mortgage is between 16 and 18%. Coming up, we've got the townhouses, some low level residential apartments on the Gold Coast, southern end of the Gold Coast,
and we've also got Oxley as well.
Yeah, we've got a really good industrial development. If anyone was in which will be a first at 10.5 and a second at 18, a highly credible counterparty who's got a proven track record. Look, if we don't have any questions, we will close off. You've got our contact details there if you want to reach out to the team. Sorry, we had a question about crime rates in southeast Queensland. Look, it's not something we've turned our mind to. I know there was something in the news this morning about adult crime, adult time. But look, we haven't had an impact. It doesn't seem to have impacted on people's willingness to move into to southeast Queensland. Certainly, demand is strong, and people seem to be, we haven't seen any negative impact at this stage. But it's something we'll keep an eye on.
And I guess just to add to that, we should kind of show that house price data. Yes. For the last 365 days and since the rate cut, and it doesn't seem to be impacting the real data. So I guess it is something to be considerate of, but we don't see it having a material impact at this stage on any of the developments we're doing. Alrighty, well, I think that's all for the questions. So we might leave everyone there. Thank you for attending the July webinar, and we'll probably have another one in 2 months or so.
Yes.
And we'll also be releasing our portfolio update for August in 2 weeks' time. So that's something to look out for in the monthly newsletter.
Thank you, Xander.
Thank you, Joe.